You are about to sign the biggest loan of your life. Your loan officer slides across a piece of paper. Your rate is higher than you hoped. But there's a line item you don't recognize. It says 2-1 Buydown. And nobody in the room is going to explain what it actually does for you. Here's the real answer. It's a way to pay a lower rate for the first 2 years of your mortgage, funded up front, often by the seller, not by you. Most buyers never hear about it. Most agents don't bring it up first. And that gap between what exists and what gets explained costs regular people thousands of dollars every single year. Let's start with what a mortgage rate actually is. It's not just a number on a page. It's the price of borrowing money, locked in for decades. When rates rise, your monthly payment rises with them, permanently, unless you refinance later. That single percentage point can mean $200 a month. Over 30 years, that's tens of thousands of dollars. Your brain doesn't process percentages well. It processes monthly cash flow. And that's exactly where the Buydown works its trick. A 2-1 Buydown doesn't change your actual interest rate. Your rate stays the same on paper, the one printed on your note. What changes is your effective payment in the first 2 years. In year 1, you pay as if your rate is 2 points lower. In year 2, 1 point lower. Then, in year 3, you pay the full rate for the rest of the loan. Someone, usually the seller or the builder, deposits money into an account at closing. That account subsidizes the difference every month until the discount runs out. Why would a seller do this? Because in a slower market, sellers can't always drop their price without spooking other buyers into thinking something's wrong with the house. But they can quietly fund a rate buydown instead. It feels invisible to everyone except you. Builders have used this move for decades. It became a headline strategy again as rates climbed past 7% in 2023, and buyers froze. Economist Robert Shiller, known for his long-running work on housing markets at Yale, has pointed out something counterintuitive for years. Buyers anchor heavily on monthly payment, far more than on the total cost of a home. That single insight explains why the 2-1 Buydown works as a sales tool. It doesn't lower what you owe, it lowers what you feel every month, right when you're deciding whether you can afford this at all. Freddie Mac's research division has tracked something similar. Their data shows that a large share of buyers who get priced out of a home do so over a gap of less than $100 a month. Not thousands, not tens of thousands. Under $100 standing between approval and rejection. A temporary rate buydown can close that gap instantly, for the exact window when a new homeowner needs the breathing room most, the first year, when moving costs, new furniture, and surprise repairs are already draining the account. So who actually benefits? Picture 2 years from now. Your income has likely grown a little. You've made a dozen payments and built a track record. Maybe rates have dropped and you refinance anyway. The buydown was never meant to be permanent. It was meant to be a bridge. A way to get you into the home now, at a rate you can manage now, while betting that your finances catch up before the discount runs out. But here's the twist almost nobody mentions. If you sell or refinance before the 2 years are up, some buydown agreements let you keep the unused portion of that subsidy as a credit. Others don't. It depends entirely on how the agreement was written, and almost no buyer reads that clause before closing. This is the paperwork most people skim past in the excitement of getting keys to a new home. There's also a version of this program combined with FHA and conventional loans, quietly written into Fannie Mae and Freddie Mac guidelines. It's allowed, it's documented, it's been available for years, and yet most first-time buyers only hear about it if their loan officer happens to bring it up, or if the builder is actively trying to move unsold inventory. This is not a scam. It's not hidden in a bad way. It's simply underexplained, buried in an industry that assumes you already know the vocabulary. Should you take one if it's offered? That depends on your plan. If you intend to stay in the home for decades, a permanent rate reduction, paid for with points at closing, might serve you better long term. But if your goal is simply surviving the first 2 years while your income grows, or while you wait for rates to fall enough to refinance, a 2-1 buydown can be the difference between qualifying today and waiting another year on the sidelines. Researchers at the Urban Institute have studied a related pattern in mortgage behavior. Buyers who postpone purchasing while waiting for perfect conditions, the perfect rate, the perfect price, often end up paying more in the long run than buyers who purchase during imperfect conditions and adjust later through refinancing. Waiting has a cost too. It's just invisible because it never shows up as a single number on a closing statement. Think about what this really reveals. Your mortgage isn't one static number, fixed and permanent from day one. It's a negotiation, layered with tools most buyers never learn exist. Points, credits, subsidies, temporary buydowns, seller concessions. The rate you're quoted is often just the starting position, not the final terms. And the industry benefits, in a strange way, from your not knowing that. This is not unique to mortgages. Nearly every large financial decision in your life works the same way. The first number you're shown is rarely the only number available. Car loans, insurance premiums, credit card interest. Somewhere behind almost every rate is a version of a 2-1 buydown, a lever someone else knows about and you don't, unless you ask the right question at the right moment. So the next time you sit across from a lender and they slide a rate across the table, ask the question almost nobody asks first. Ask if a temporary buydown is available, and who would be paying for it. That single sentence can change your first 2 years in a new home, sometimes by more than you'd save clipping every other coupon in your life combined. Let's slow down and actually run the math, because the abstract version of this story doesn't hit the same way the real numbers do. Imagine a $400,000 loan at 7%. Your standard monthly principal and interest payment lands around $2,600. Now apply a 2-1 buydown. In year 1, you effectively pay as if your rate is 5%. That drops your payment to roughly $2,100. In year 2, you pay as if your rate is 6%, landing near $2,400. Only in year 3 does the full $2,600 payment arrive. That's a difference of almost $500 a month in year 1 alone. Multiply that across 12 months, and you're looking at nearly $6,000 of breathing room, deposited quietly into an escrow account before you ever move a single box. Where does that $6,000 actually come from? In most cases, it's built into the negotiation of the home price itself. The seller agrees to contribute a set dollar amount at closing, sometimes called a seller concession, and that money doesn't go to you directly. It goes into a dedicated buydown account, administered by the lender, which pays the difference between your discounted payment and your actual payment every single month for 2 years. If you make every payment on time for those 2 years, the account simply runs itself down to zero, exactly on schedule, and your payment rises to match your real rate. Now consider the version almost nobody warns you about. What happens if you miss payments, or if the loan is paid off early through a refinance or a sale? Buydown agreements differ here, and this is the exact clause worth asking your loan officer to walk you through line by line. Some agreements return unused funds to the seller. Some return them to you as a credit. Some simply forfeit whatever remains in the account. None of this is illegal or predatory. It's simply a contract term that varies lender to lender. And the only people who tend to read it closely are the ones who've already been burned by not reading closely enough on a previous deal. There's a psychological piece to all of this worth sitting with. Behavioral economists have long studied something called payment shock, the jarring feeling of a bill increasing sharply after a period of stability. A 2-1 buydown, by definition, is engineered to create a controlled, predictable version of exactly that shock, twice, once at the 12-month mark and again at the 24-month mark. Financial counselors who work with first-time buyers often stress this exact point. The program only works in your favor if you plan for the increase in advance, treating years 1 and 2 as a rehearsal for the real payment, not as your new permanent baseline. Buyers who spend every extra dollar of that temporary savings, rather than banking even half of it, are the ones who feel the most pain when year 3 arrives. This is also where the timing of interest rate cycles matters enormously. A 2-1 buydown was originally built for a very specific kind of market, one where rates are expected to fall within a year or two, allowing a buyer to refinance out of the higher permanent rate before ever paying it in full. That was common through much of the 2000s. But in a market where rates might stay elevated for years, the buydown becomes something different. It's less a bridge to a better rate and more a 2-year discount on an otherwise fixed cost. Neither use is wrong, but confusing one for the other is exactly how a buyer ends up surprised on their 13th mortgage statement. It's worth asking why builders, more than individual home sellers, have become the biggest users of this tool in recent years. A private homeowner selling one house has limited room to negotiate. A builder moving 40 unsold units in a subdivision has an entirely different set of incentives. Buying down a buyer's rate for 2 years costs the builder a fixed, predictable amount per home, money they can absorb into their overall construction budget far more easily than dropping the sale price across an entire development. Dropping prices resets the comparable value of every other home in that subdivision, sometimes by hundreds of thousands of dollars in aggregate. A quiet rate buydown does not. It moves inventory without moving the appraised value of everything around it, which is precisely why so many builders reach for it first, and why so few of them lead with the sticker price discount instead. None of this means a 2-1 buydown is automatically the right move for you. If your household income is flat, and you don't expect the extra breathing room in years 1 and 2 to translate into meaningfully better financial footing by year 3, you may be better served asking for a permanent rate reduction through discount points instead, paid for once, at closing, rather than a temporary subsidy that expires. The right choice depends entirely on what you expect your life to look like in 24 months, something no lender can calculate for you, because only you actually know it. What this really comes down to is a simple, uncomfortable truth about how large financial products are sold in this country. The version of the deal you're shown first is rarely the only version available. It's simply the version that requires the least explanation and the least effort from the person selling it to you. A 2-1 buydown has existed in mortgage guidelines for decades. It is not new, not secret in any legal sense, and not particularly complicated once someone actually walks you through it. And yet it remains functionally invisible to a huge share of buyers, not because anyone is hiding it, but because nobody in the transaction is required to bring it up unless you ask. You walked into this thinking a mortgage rate was fixed the moment you signed. It never was. It's negotiable, layered, and quietly flexible, if you know where to look. And that one line item, the one nobody explains, might be the cheapest 2 years you ever buy.